Good morning, everyone. Welcome to the new week. It is the macro snapshot for Monday, August the 25th, 2025. Okay, let's have a look. A fairly sort of quiet opening to the week, to be honest. We also have a bank holiday, so the markets are closed in the United Kingdom. But obviously, the market is really just absorbing the Powell's sort of speech on Friday. So let's just have a quick look and see where we are in terms of the Fed. And the FOMC and what the market took away from that. So now for the September meeting, you can see here we've gone up to 20 basis points which has been discounted. So essentially an 82% chance of a cut. And then by the end of the year, we're sort of just hovering above that sort of two cut level. So a dovish reaction, but not a massively dovish reaction. And if we actually just look here, we can see this is the pricing for December, just on the tick charts, so the short term. And you can see that initially the market interpreted Powell's comments as being very, very dovish. But subsequent to that, we got down to about, about 58 basis points or so. But we've given back about sort of five or so basis points. Let me just make this a little larger here. Yeah. So so you can see here that we've actually given back about 5 or 6 basis points. So in terms of what Powell actually said, just got some quotes here, which I think for me were the most important ones. So the market interpreted in a dovish way, and that's just because in terms of the employment situation, there's a quote. He said, "The downside risks to employment are rising." So he acknowledges the fact that there is a weakening in the labor market. He says that policy is in restrictive territory. So that's interesting because there had been some debate, what was the Fed actually even restrictive at this point? But Powell himself was stating that he believed that the policy was in restrictive territory, and therefore it could come down a little bit. There was a shifting balance of risks. So a shifting balance of risk. So acknowledging some kind of pivot potentially in the real economy. And that may warrant adjusting our policy stance. So it's interesting because the market did initially take this very dovishly. But I mean, I know he's a central banker, but he did use the conditional tense here, may warrant adjusting our policy stance. So that does leave open the possibility that, as the market is saying here, that there's still a 20% chance that, may not warrant a cut. Let's say, for example, the inflation data comes in hotter than expected. And let's say, for example, that the non-farm payroll, so the employment numbers and other real economy stuff, but especially the labor market numbers come in very hot. Powell has said that he may not cut. So there's still the 20% chance of not cutting. Although at this point, as we say, it looks as though over 80%. Now, in terms of the tariffs effects on inflation, and keep in mind, that was sort of ostensibly the reason for which they hadn't been cutting in the last 2 or 3 months, was this fear of inflation being caused by the tariff pass-through. But he did say that a reasonable base case would be for a relatively short-lived effect. So relatively short-lived effects for a one-time shift in the price level. So a one-time shift in the price level. So Powell himself seems to be now leaning towards the camp, which is essentially saying, hey, prices might go up a little bit, but it's going to be a one-off, and then it's going to be relatively short-lived because the underlying sort of sense of the economy is potentially sort of weakening, and growth is potentially, not accelerating as much as before. And then he spoke also on the potential for wages causing inflation. And he is interesting, again, talking about the labor market. He said the labor market is not particularly tight and faces increasing downside risk. So again, there was that sort of slight pessimism about the labor market. So the outcome, so the possibility, the possible result of workers demanding and getting higher wages does not seem likely. So essentially what he's saying is that, hey, maybe we could get, some costs going up in society for goods and services. Okay, does that mean that, employees and workers are going to ask for more money? Probably, possibly. Are they going to get it? Maybe not, because the labor market is not particularly tight. And so he was basically poo-pooing the idea that there could be another inflation spiral caused by wages going up. So underlying all of that, there does seem to be a sense in Powell that, okay, there might be a little bit of inflation, but the labor market does seem to be weakening, or at least the balance of risk towards it weakening is increasing. And because that is the case, the idea that there's going to be some kind of spiral does not seem to be sort of highly probable. And therefore, to be prudent, it could be, and again, getting back to his initial comment, it could be that it may warrant adjusting or cutting their sort of policy stance, or basically cutting their interest rates. So as I say, Well, what we did get was initially, a fairly sort of dovish reaction here, about sort of 10 basis points, but the market's giving those back. And just in terms of a couple of things, just to pick up on Powell, let's actually see, excuse me, the situation. Let's see the situation. I'm just grabbing some tea. Let's see the situation in terms of being restrictive. So if we look here, what we've got on this sort of chart here on the Bloomberg is basically the Fed funds rate, the effective rate, which is this line above here, and this is the core PCE. So keep in mind that their measure. I mean, they obviously look at dozens and dozens of inflation measurements, but the core one is the PCE, the core PCE. And what we can see here, going back to 2021, you can see that inflation did go all the way up the core PC up over to 5, almost up to 6%. And before they started hiking, this is the hikes here, you can see that they were they were incredibly loose. They were actually about minus 5% in terms of incredible looseness in that period in 2021, 2022. But then, okay, they started hiking. And then what you can see now is that the effective Fed funds rate, got up all the way up, to about 5.3. And of course, as we know, it has come down. We're now at about 4.33% for the effective Fed funds rate. And of course, also on the other side, this orange line here, which is the core PCE, that itself has stabilized and come down. But as you can see here, it's pretty much sort of stable here at about 2.8%, and it hasn't really got down to their 2% target, which of course would be a little bit lower. So the point I'm trying to make here is that, are they restrictive or not? Well, the most restrictive was back in the middle of 2024, where you could argue they were almost 3% in restrictive territory, which historically is quite a lot. And if you look at someone like John Williams, the head of the New York Fed, he says that his measure of restrictive is anything above about 50 to 75 basis points. So certainly by the measurement of someone like John Williams at the New York Fed, they were quite restrictive back in 2024. But as the situation has gone on, and inflation has not moderated, and they have cut a couple of times here, you can see that now they're about 1.5%. So if you look at this metric, it's one of the ways of looking at it. They're still about 1.5% in slightly that it's a little bit restrictive territory. So is it correct for Powell to say that they are in restrictive territory? I think that's reasonable. Now, if we look at, let's say, the inflation swaps, what's happening? What does the market think about where inflation's going? And it is interesting that there is this perspective. If you look at the white one here, which is here, this is for the 1 year. So this is the market-based measurements of where the market thinks inflation will be. And you can basically see here that once Trump got into power, this is beginning of the year, you can see that the inflation expectations did go up, and the 1 year one, which is the white line here, they still remained elevated, especially when we got the whole situation of Liberation Day and the tariffs. You see here it spiked up to 3.6. It's subsequently come down a little bit, but you can see that even over the last couple of months or so, the 1 year inflation expectation swap is still at about 3.4%. So still quite elevated. Now, the thing is, I suppose what's going to keep Powell happy is that if we look at, let's say, the 2 year, it's only above 3. And if you look at the 3 year, and then the going out to the 5, and let's say something like the 5 year here, you can see it's about 2.7. So I guess before that, Powell and company, they could have said, well, okay, we're going to the markets can deal with a little bit of inflation for 6 or 8 or 12 months, but then things look as though it's calming down. But what is interesting to me is that even in the 2 year and the 3 and the 5, you can see here that started to spike up a little bit, and we're still for the 2 year over 3%. So you can't really just say, oh, we're expecting inflation to go away after 6 months. The market is not saying that. The market is saying that even over 2 years, it is still expected to hover around 3%. Now, there is some talk as well that, the new normal at the Fed is basically letting the inflation target run a little bit higher. It's not realistic to say 2%, maybe 2.5, 2.75 is, a sort of a de facto kind of goal. But Powell, remember, one of the other important things about his speech on Friday was that this whole, average inflation targeting, essentially they've abandoned that. Remember, they brought that in 2020, and this idea that if inflation had been persistently low, they wouldn't mind letting it running hot for a certain period of year, a certain period of time to have some kind of average around 2%. That seems to have been a disaster because we know that in 2000, and 21, 22, we had, very, very high inflation. And so one of the specific things which Powell said last Friday was that that framework seems to have been essentially abandoned and dropped. And now they might get back to what we might call their traditional monetary policy of being a little bit more preemptive, of having 2% really as the target and actually as a topmost cap and limit. So that in theory should be quite hawkish, and that should in theory, at least sort of philosophically or theoretically, argue for a Fed which is quite hawkish. And that's why just reflecting upon Powell's speech, I didn't find it in its totality to be dovish. You could argue that, sure, he sort of winked at the market and said probably something's happening in September. But if you step back and look at the theoretical framework, ostensibly, at least in my viewpoint, that should be relatively hawkish because it indicates a Fed which is no longer going to do that average inflation targeting, but is going to get back to, as I say, a more sort of traditional old school kind of Fed, which is targeting 2%. And therefore, that would necessitate, with inflation up into the late twos, even over to three, and inflation swaps the market as well over 3%, it would necessitate more certainly not cuts by the Fed, maybe just holding it steady as we go. So interesting to know if whether ultimately there was political pressure. Now, in terms of a Fed which is faced with a pretty strong economy, a strong labor market, and a lot of political pressure to cut, we see here that with the inflation swaps that they are sort of signaling inflation, being relatively sticky, even going out to the long end. But if we go out to the long end here, you can see it's over about 2.5% still. Now, you can argue that's not massive, but what is interesting, I've just got a chart here. I brought up all of the for developed markets, the yield for the 30-year bonds. And you can see that these, in general, especially if you look at this is a sort of how can I say normalized. This is normalized, so this is not actual yield levels. This is the rate of change. But you can see that essentially over this year, in most of the developed markets, the US, Germany, Japan, yields have gone up quite a lot at the long end. You can see here in Japan, which is this one, you can see here that's gone up like a lot. And then if you look at also Germany, so you can see that Germany and Japan have gone up a lot. And you can also see that the US too has sort of climbed a little bit higher. So it does seem that around the world there are concerns that globally sort of governments are losing their fiscal discipline. They kind of have been unshackled by the largesse which was unleashed during the COVID years, and that a combination of sort of more military spending, basically slowing economies or perceived slowing economy, the potential for slowing economies, and the desire to protect themselves against let's say a tariff war or something. It seems as though the deficit spending is here to stay, and it's just interesting to note that the bond market at least is sort of signaling sort of higher yields as a sort of a structural part of where we get to. And the reason I'm raising that is just because at a certain point, if we keep on getting higher and higher long-term yields in the 10s and especially the 30s, at what point will that start to really sort of push down on sort of housing markets and also global equities as we get those high nominal yields and also real yields? But we'll talk about that another day, but that's just something to keep in mind. Just talking about Japan, while we've got that up here, as I said, I've got the Japanese one, which is here, the JGBs here. You see just how much the 30-year yield has risen. And it's kind of interesting to Ueda from the Bank of Japan also gave a speech at the Jackson Hole Symposium, at which he said that the labor market was expected to remain pretty tight, and that therefore he thought that that would be putting upward pressure, quite significant upward pressure on wages. And he also talked about the demographic pressures really since the 1980s in Japan over the last 40, 50 years, whereby just a falling population is really starting to cause labor shortages and therefore, in economic terms, upward pressures. And therefore, that could be a continuing sort of source of structural inflation. And that would argue potentially for normalization in policy and hiking interest rates and also longer higher yields, of course. That's the point. And if we go to Japan, just having a quick look at that, it's interesting just to see what's priced in. At this point, for their meeting on the 19th of September, so still about 3 weeks away. At this point, only about a 12% chance of a cut is priced in, 3 basis points. So the market at this point certainly is not discounting a cut. And so you have to say, well, what is the market discounting? And it would have to go basically into 2026, sort of January, March, around there. We start, let's call it January, you got about, well, actually January, 98% of the first cut. So the market is expecting one cut coming in some shape or form from the BOJ. So it'll be interesting to see if we do get increasing evidence of wage inflation in Japan, whereas Ueda, where we'll see whether Ueda's comments actually will cause the Bank of Japan to hike maybe before January of 2026, and maybe one of these meetings, maybe October or December, which looks a little bit underpriced. So that's something interesting to keep an eye on there. Okay, let's have just a quick look. Not a huge amount of data this week. Actually, sorry, let's just go back. Not really much data at all. Just sort of bring that back here. As you can see, we have new home sales. That will be interesting. That's coming up today at 10 o'clock, just to see the housing market. So that for sure is interesting. But apart from that, not a huge amount. Durable goods. We get the preliminary number here for July. It's a very choppy number, but it's going to give us something. But really, the big one's going to be inflation and employment numbers. But let's definitely keep an eye on those nonetheless, just to see what's going on. Okay, so I just want to have a quick look and just see where the markets are in general and their reaction. So I'm going to put it on a 15-minute chart here, and you can see that volatility absolutely sort of collapsed after Powell, and that's normal after an event risk has passed. But just the dovish tone also caused the market to relax a little bit. It's opened a little bit high, but still you can see we're at 15s in the VIX, so under 1% divided by 16 to get the daily move, implied move. So we're under about 90 basis points at this point, 90, 92 basis points of move. So still pretty low vol at this point. And that's the same if you look everywhere. If you look at gold in the 15s, if you look at oil, pretty low as well. So volatility overall is low. If we look at the ES, the stocks obviously liking that talk of sort of potential sort of rate cuts. But it's interesting. We'll see. We have NVIDIA earnings coming up. So the point I'm trying to make here is that at what point, if we get a slowdown in economic data and if we get sort of a weakening in the labor market, at what point will that sort of quote unquote bad news start to feed into the stock market? At this point, the stock market seems to be much happier just taking the rate cuts news, and it's not so sort of interested in understanding why a rate cut could be necessary if we have a labor market which is weakening. So I don't think we're at that point yet, but that's going to be interesting as a potential sort of pivot and tipping point. So as you can see at this point, ES equities up. We see the NASDAQ also coming up, everything giving up a little bit. The Russell in particular not giving back as much. So the Russell actually pretty happy with the potential for lower interest rates within the United States. If we look at global equity, we can also see, let's say, going across to Europe. Europe, again, had an initial pop on that, but is giving back a little bit. We had this morning IFO sentiment survey in Germany, which was relatively positive. But there was some talk at Jackson Hole and just speeches of Lagarde that they are a little bit concerned in Europe about a sort of a slowing of the economy. And so therefore, it's going to be interesting just to see whether we start getting rather than an underperformance of US stocks, we get an outperformance of US stocks over European stocks. So that's something interesting. If we look at the Nikkei, we see the Nikkei, actually not doing that well. And maybe that's just with a slightly stronger yen. And maybe the talk of Ueda of sort of higher wages and whatnot. But getting on to other markets here, I just want to have a look at the US. So we see here into the front end of the curve. Obviously, the front end of the curve, the ZT, liking that, as did the SOFRs. So if we go at something like, let's look at, let's say, for example, September of 26, you see the SOFR curve here, pretty similar to, actually not the SOFR curve, just the SOFR for September 26, also enjoying the front end of the curve, but giving back, maybe about 40, 50% of that move as we, the market just sort of analyzes it a little bit more. In terms of oil, not a huge, actually, just getting back here. So we look at the 2-year, that's what the 2-year reaction. So if we go out to the longer end of the curve, let's say something like the Ultra Bond, you can see a very different reaction. So again, look at the 2-year. it's kept most of its gains. Whereas if you look at something like the Ultra bond, which really is more like the 30-year bond, you can see there was an initial pop, but even by 1 o'clock, so a few hours after, 3 hours after Powell's speech, you can see that already that's coming off quite a lot. So we're getting quite a lot of steepening here. And again, it's the idea of the Fed may be cutting, but as they're cutting, they're less aggressive fighting inflation, and deficit spending is still not stopping in any shape or form. So starting to get some sort of bear steepening here, and occasionally bull steepening as well. So, but basically, this steepening does seem to be very much a tendency which we can see. In terms of oil, oil just grinding a little bit higher here. It's been grinding higher, probably just on the fact that the economy globally seems to be doing okay, and also just in terms of Ukraine and Russia, there's no immediate prospect there for a ceasefire. I think that's probably sort of weeks, months away. And Trump's dreams of, with a stroke of a pen, just stopping that is not going to happen. So oil, probably also at relatively interesting technical levels here. You see here, it's just having a nice little bounce here off this sort of support. But again, it will start to find some resistance. We'll get into that maybe a little bit more tomorrow. And again, just want to get back to the reaction. So the dollar, of course, weakened on Powell's speech. You see here again, back to the 15-minute chart, the dollar weakened, but again, just sort of grinding up a little bit. Still not a huge move backwards, but just maybe a bit of profit taking and just a little bit of a retracement here. But essentially, the structural weaknesses for the dollar. I mean, you could argue they remain in the sense that we have less independence from the Fed, we have less fiscal discipline, we have some sticky inflation, and we also have a Fed which is potentially cutting interest rates. None of that is good for the dollar, and so you'd have to sort of think that the dollar may have, structurally a more weakness here. And as you can see, this downtrend is just sort of bouncing along within a trade. And once everyone gets back into the office, let's say, especially by next week coming into September, be interesting to see whether that does fall a little bit. We'll keep our eyes on that. Apart from similar kind of thing for the other currencies, we can see here the euro obviously having a little bit of a pop on Powell, but giving back a little bit. And again, that's going to be a story in the next quarter, September, October, November, about the European economy. Does it justify these sort of lofty levels of the euro? Something which is going to be interesting as well is the Japanese yen. We saw Ueda's comment. So we saw here that the US dollar fell, obviously strongly on Friday, like everything, because of Powell's speech. But what's going to be interesting here is just to see whether this continues to fall and whether, what Ueda was saying about inflation and the possibility of the BOJ, maybe normalizing and hiking interest rates. Will we see the dollar break through this kind of uptrend here and sort of fall? It does look a little bit precarious here. And you'd have to say that any sort of confirmation of Fed interest rate cuts or weakening data in the US, especially labor market data, combined with a more aggressive Bank of Japan and a strengthening Japanese economy, that could see the US dollar retesting down to, the 142s and eventually down to the 140 level over the next month or two. That's going to be an interesting one, definitely to be looking at there. Apart from that, as I say, I just want to look at the bonds, just looking at the curve. You can see here the steepener looks in the 230s as though it's breaking out of this trade range here. And now, if that's the case, we can put this on a weekly chart and just see that this is grinding upwards. And this does look pretty bullish, as you can see here, just grinding higher and higher. And then you say, well, where can this go? If we go back a little bit on a weekly chart, you can see that, at a pretty key level here, we might find some resistance at, let's say, 125 basis points or so. But for sure, this thing does have the possibility of grinding, another 20 or 30 basis points higher. Similar kind of situation here if you look at the 2s, 10s. Not quite as steep, but definitely overall the trend here is steepening, and it looks as though this may want to sort of test a bit higher. Again, this is on the weekly chart, and not maybe as much as the 2s, 30s. But what is also interesting is the 10s, 30s, and I'll put this back on the daily. You can see the 10s, 30s is also it continues to steepen. And that's interesting because a lot of people often look at the 10s, 30s as kind of a risk premium, term premium sort of thing. Because honestly, if you're, buying duration, between a 10 and 30, you wouldn't expect it to steepen this much unless people are maybe, if they want duration, maybe buying 30s, maybe hedging it with a 10, or essentially saying, hey, if you want me to buy duration like the 30-year, I need to have a little bit of a term premium and risk premium, and that's creating that spread, which is becoming quite aggressive between the 10s and the 30s. And again, just a bit of historical perspective here. You can see that this has been on a weekly chart steepening a lot. So that's really telling you all you need to know about what the market thinks of fiscal discipline in the US and the requirement for higher yields out the curve. And you can see that technically could still go, there's no reason why they can't go another 10 or 15, 20 basis points, grind higher over the next few weeks and months as well. So definitely overall a steepening curve. Just finally want to have a look at gold and whatnot. Gold had a pop on Powell's speech. Again, just a sideways consolidation here. But as I said a few days ago, the thing which is interesting to me is that this is not actually falling. So it's difficult even to talk about a retracement here. So this chart, although it's not ripping to new highs, you have to say that this is very solid, solid, sort of point of control for the technicians out there. It's if I just bring on the moving averages, which I'll just just find here. Let's bring on some moving averages here. You can see here that it's above all the moving averages. And so this is still a very constructive chart. And if the US continues to not fully combat inflation and cuts interest rates, lets the economy run a bit hot, continues to issue a lot of bonds, and there's also a little less trust maybe in the overall ecosystem and independence of the American sort of central banking system and treasury, you have to say that these are all propitious conditions for gold to keep on grinding higher. So we do have this sort of semi sort of resistance downtrend line here. Would not surprise me if that pops higher and at least starts testing up towards 3470 or even up towards the top of this range at 3500. Maybe not the spike here because that was a little bit the COMEX arbitrage trade with the tariffs. So if we look on the gold spot price, you see it's a bit more realistic here. And I think, this maybe has a bit more to go, but definitely can get up to the top of this range here. It's something to be looking out for. Similar situation in silver. You see that silver here on the futures here can definitely sort of pop a little bit higher, and it would not surprise me at all if that pops up and tests, up towards $40 in its recent high. Especially in the context of silver, about 55% of global usage is actually real usage for industrial purposes. And so as we sort of electrify the world and whatnot, and a little bit of a safe haven sort of bid, following gold. I think silver is also in a fairly strong position here to grind a little bit higher. Just finally, want to have a quick look at copper. I'm going to look at the London price, which is less affected by all of the tariff sort of arbitrage and whatnot. You can see here, just in the middle of a range, probably looking for some more direction. From just the global economy. Not really bad, not really good, just sort of plodding along, not a huge amount of energy there at the moment. Okay, guys, I'll leave it there. Just the introduction to the week. Let's see what happens. We get a little bit of data starting to come through. Let's see if we get some Fed speakers as well. See if there's some kind of bifurcation on the Fed between those who are angling for the job and really trying to please Trump and being, very, very dovish, and whether there are some who are being a little bit more circumspect and a little bit more data dependent. So it's going to be quite interesting as we go through the week or two, just to start getting the different sense of what different members of the Fed are sort of prognosticating. Okay, thanks very much. We'll keep this going tomorrow. Have a great day. Thank you.